This month, Life Insurance Strategies Group is back in Chuburna in the Yucatan, Mexico. And all summer long, I've been answering questions about investor control. So in the private placement life insurance world, all of you know, I'm sure by now, that there are probably a handful of very important rules. Probably the one most important rule is don't violate the investor control doctrine. And why is that the most important? Well, it's actually one of the easiest for an audit to uncover, and we'll talk about that. But first, let's kind of talk about what constitutes investor control, because I get people calling me up saying, hey, what if I do this and what if I do that? And my answer is always, you can do that. You can do whatever you want in investor control or in private placement life insurance. But the question is, well, what happens to you if you get caught? What's the downside to that? So first of all, with investor control, a lot of people think about the Weber tax court decision from 2015. And in that decision, there were kind of 3 points that the court made. They said, look, who has the power to extract funds from an account? Who has the power to exercise rights? Who has the power to direct investments? And these are all very important. But there's actually a point that goes back to 1983 to a private letter ruling that people forget about. And that's, you cannot have a prearranged plan. So you can't have a prearranged plan about specifically what you're going to put into PPLI. Now that doesn't count insurance dedicated funds. Those are separate legal entities. You can, obviously think about, I want to select a specific insurance dedicated fund, IDF. Now, obviously, you can't have any say in what the manager is actually doing inside of that fund. So, for instance, if it was a private credit fund, you can't have any say in the type of deals that fund is doing. But let's talk about if you were using a managed account under a PPLI policy. Then we can't be telling the manager what to invest in specifically, either before or when the policy is in force. So that's pretty clear. What's muddy out there right now is we sort of have people thinking about doing an option strategy. This is where they have a private company and they're going to issue options in that company and put those options into a policy when there's no basis, right away, so that when those policies jump in value, you capture that value inside the policy. Now, theoretically, I suppose it could work like this. You have a minority investment in a company where you don't have a board seat or any control position, and they're issuing options. And your investment manager says to you, hey, it might be a good idea to get those options inside of a policy, along with other investments for diversification. You know what? That might work. Probably what's not going to work is if you own the company, you're issuing options, then the argument's like, well, you really don't control those options, but you might control exercising those options. You certainly control the company. But I'll tell you what the big killer there is. I bet if you were audited, that if they were to pull the email communications, all of that is a prearranged plan. I bet there's emails going back and forth between the client, the investment manager, the client and the insurance company's valuation company that they brought in to help do the options, right? So I think you get hung up and violate investor control there by having a prearranged plan, if not for sure those other points. So definitely a problem there. Now let's talk about what happens. So obviously if the IRS comes in and says, hey, you violated the investor control doctrine, what could happen is, like any time an IRS comes in to audit you, they look back 3 years. So you could go back in time 3 years and lose all the benefits here of life insurance, that tax-free buildup, any tax-free, withdrawal of the loans, etc. But if it's a certain amount of your income, the IRS can push back 6 years. And in PPLI, these are usually pretty big policies. So I would expect that you probably would get looked back 6 years against the benefits of PPLI. So you wouldn't have those benefits, and that could be catastrophic. Now, what's the risk of being audited? Well, maybe 10, 20 years ago, very little with PPLI. Usually it was you were audited for something else. The IRS said, we hate this person so much. We see that they have a PPLI. We're going to subpoena the email communications between the investment manager and the client and see if there's investor control. That's the easiest thing. But today, it's not so much that I think you'd be audited for the private placement, but you might be audited for techniques you used around private placement in your wealth planning, like intergenerational split dollar, where there's a discounting of a note, or maybe you've discounted business interest to move into a trust. So other things, but then again, they see the PPLI and say, hey, easy way to audit or look at this PPLI is to audit for investor control, and we'll pull the emails. So the risk is getting higher that there'll be an audit. And I just tell you, life insurance in general is about risk transfer. So when you start doing kind of aggressive techniques to layer on that risk for a risk transfer technique, that doesn't make much sense, does it? And you could be in a lot of trouble. Now remember, at Life Insurance Strategies Group, we don't sell products. We help our individual affluent clients and corporate clients make decisions involving complex life insurance transactions. And if we can be of help to you, reach out to us at lifeinsurancestrategiesgroup.com.